the illustration. So once you log into our website through your NAA portal, it's going to take you to the illustration software for both the life and the annuity piece. We have it all nice and neat in one spot, which is great. So once that opens up here, then you're just going to click on a new illustration, and then this product menu comes up. Forgive mine, there's a lot of different ones here. You could certainly toggle down on the product type to do Index Universal Life or one of the annuities. Mine's set to any. I usually just click on whichever product name I'm doing. So there's all of our fit annuity products there. I know we typically highlight the rewards growth, and that guaranteed income does a really good job of complementing most all your client needs on annuity. But all of them are there, and then on the life side, there's that Flex Life 2 that we want. So we'll click on that, and then our case design first pops up. So I kind of look at this like I'm reading a book. So I got different tabs, and then I'll go left, right, up to bottom on my tab. So that first one is the client information section. Notice that, again, we've got some yellow kind of cautions saying right now I can't jump into the IGO app from this because I don't have all the full data, right? But once we start actually plugging in actual data here, then you'll notice those yellow exclamation marks are going away. Now, Gina, I'm going to stay on your good side, hopefully. So let's do that. And then notice specifically, it's actually a fun way to do it. So specifically, if we're doing a case where it's a minor involved, then you'll notice this owner information section pops up. And again, for the e-app, to be able to launch the e-app, we need to put the actual client's name in, even for the owner, right? So once you have actual live data there, then now that IGO e-app button turns green. Now we can launch the e-app from this illustration. So even if we're working with a minor, you can still do an e-app for a minor, but you want to have that data there first. Moving along, now once we have that piece in there, then what we'll do is we'll go over to our death benefit and funding tab. So death benefit and funding, this is where we basically tell the software what we're trying to accomplish on the illustration. So you can do this forwards or backwards, no matter where you're starting at on your case. The illustration software will help you. I do know some of you guys will look at a case and you'll say, hey, the client really wants, $250,000 of death benefit, but they want to max fund it. So you would, on something like that, you would simply just type the death benefit that you do know, and then down on the premium section, if you were wanting to max fund it, then you're simply just clicking on the guideline annual premium, would be that maximum amount. The from through box, you'll see the from through box on a few different spots here. What from through simply means is how long are you doing whatever it is you're currently doing, right? So on the death benefit, where we want $250,000 in death benefit, we don't want that to lapse ever. So we're going to leave that from through alone, right? We'll just leave it at 1-M. But let's say for premium, right? Maybe Gina doesn't want to pay this for all years, right? We want to pay till retirement, let's say. So you could sit and count the numbers. Okay, if my client's 30 and retire at 65, that's 35 years. You could do that. I typically try to not have to do math if I don't have to. So what I typically will do is I'll do 1-A65, meaning I want to pay the guideline premium from the first policy year through the age of 65. Right, that's what I'm telling the system to do in that scenario. And then if I wanted to show any income, then that's where I would put that down here in the income section. I'll show you that in a second, but I wanted to show you. So that's what it looks like if we know our face amount. We're trying to figure out, hey, just how much premium could we put in, right? There's our $250,000 as a face amount that we see here. I did level in this particular instance. You could certainly do increasing if you wanted to. And then my what I'm paying is $176.83 per month, or $21.22 per year, right? Notice that matches up with the guideline level premium. So pretty straightforward if we are doing it that way. But what I've learned in talking with a lot of you guys and helping you kind of get used to this system so that you can run these on your own, most of the time I feel like you guys are typically running it from the other side. You don't necessarily know a death benefit. You know the premium that the client wants to pay, right? Well, luckily the illustration, it can work for that too. So what you would do in that scenario is you would go to what you know first. So I'm gonna even leave the death benefit alone, even though it defaults to 100,000 normally. I'm gonna leave it alone for now. We'll come back. But if I focus on premium first, what I do know, let's say they wanted to pay a premium of, I don't know, let's say they wanted to do 400 bucks a month. So there's my 400 a month. I'm not adjusting it in this scenario. Adjustment would be like if you wanted to increase it by a certain dollar amount or a certain percentage every year, you could do that. IULs work best when they are overfunded, but overfunded consistently, right? So the best IULs are certainly ones that are overfunded, but the top echelon of those products are going to be ones that are consistently overfunded year to year. So if we wanted to do that, we would say, okay, well, I'm going to do 400 bucks a month, and I want to do just that. I want to be paying the most I can pay to really maximize this cash value. I want the smallest death benefit possible, okay? And so if we do that on the min-max for our death benefit, you'll notice that death benefit went away, right? Now it's grayed out. I can't type any numbers here on that face amount. And then I'm going to still do level A on this one, although I will show you guys an increasing one here later on today. But so we'll do min-max on level option A. Because I'm starting level, I'm going to never change it to increasing, right? So change year, we're going to leave that at M for maturity. I would say that you're probably going to do that if it's at level, at least initially on the illustration. If you started this on increasing, you might do a change year later on, but we'll leave it at level A, and we're going to pay that 400 bucks a month to age 65. Now, I'm not going to do a 1035 in this one, but if y'all wanted to see what one looks like, you would just put it in external 1035 exchange. Now, this yellow thing doesn't mean I can't do it. What it does mean is that when I launch the e-app from here, it can't pull over this 1035 info. And so kind of the workaround on that is what we would do is we would basically say, hey, we'd figure out what the death benefit is now. So as an example, right now you'll see it's 589 of death benefit without an exchange. But if we said, hey, we've got 100,000, we're moving over, that death benefit will tweak up just a little bit in this scenario. But what we would do is once you have that death benefit, you could take it off of min-max. It'll give you that death benefit. You can take off your 1035, and now my e-app is going to show up green again. So you could still do the e-app. You just kind of got to massage that system a little bit, or really call me or Lindsay or our sales desk. We can help you run that. But let's say we're not doing a 1035 in this one. We're just going to do 400 bucks a month. We're starting from scratch, but we do want to show income, right? So down here on our income section, we got a few different options here. I'm going to pick on the lifetime income benefit one, but I'll speak to all three so that you guys know. So what I would recommend when you're talking about income or when you're illustrating income is focus on the story, right? I personally don't think I don't think you're going to do yourself any favors if you show every single way to take income out for the client. You're just going to confuse the client, right? And so I would pick one of these to illustrate, but you could talk about all three, right? So the specify amount option would be if you know how much money you want to take out. So let's say you wanted to show money coming out in 20 years from now to pay for a child's education, right? You could do specify amount to type out, that specific dollar amount. So that would be the specify amount option. If you wanted to the solve for income feature, solve for income is going to tell you what's the most money you could take out for whatever your from through specified time period is, and the policy still reach maturity. So that's important. We want the policy to reach maturity because if it doesn't, if it surrenders or if it lapses, then loans that they've taken could be taxable if it's more than what they put in. So solve for income is going to make sure the policy still runs to maturity. But the lifetime income benefit, again, that's the one you've probably heard me and Lindsay talk about. It's super strong, you guys. It is a guaranteed income stream as long as your client lives. The policy at that point, if you get to that stage and you turn on that lifetime income benefit rider, you're always going to have at least 15,000 of net death benefit, right? Basically, hey, let's let NLG, LSW, let's let us pay for the burial, right? As well as that policy is at that point not going to lapse, right? And once you turn on that rider, this policy cannot lapse. And then for those of you heavy hitters that I know you guys are writing new clients left and right, it's going to be a lot easier to manage this from a service standpoint. You don't have to send in the loan page every year, right? Once we turn on that lifetime income benefit, we'll just mail the client, we'll wire that money every year on whatever date they specify, right? So again, really cool options for everybody involved. So that's the one that I'm going to illustrate for now. So it defaults to the year after I stopped paying premium. It did do the actual policy years, but you'll see in a second that 37 policy year is age 66 in this scenario. Notice when we do the lifetime income benefit, our loan type locks. It's grayed out on standard, right? I can't click that arrow to change it to a variable loan, which is good. It's a guarantee. You know, we know it'll be guaranteed money when it comes out. Now, there's two options here. One that offers an increasing payout option. So you could start off with a smaller amount, but it would increase every year until you completely liquidate the cash value. You could do that, although the default is to no. And then the other option is to do a LIBOR face amount reduction. And that one is defaulted to yes, because we're trying to give you a bigger income stream. So the thought would be, hey, you no longer need the big 589 of death benefit because you didn't pass away early. You now want to use this for tax-free income. So let's reduce the face amount a little bit to boost the income. Again, it's defaulted to yes. You don't have to use it. You could just uncheck it if you wanted to keep the same face amount. So let's jump into, well, before we get to quick view, I do want to show the riders and interest rates. So I don't spend a ton of time on this page because you'll notice the awesome riders that we talk about that are free or they're built in. Those are already marked yes for us, right? So really the only time you need to go to the rider section is if you're going to add a rider that costs money, like a waiver of premium or like a children's term, something like that. Or if you wanted to change the ABR summary age. I'll give you an example. This doesn't happen all that often, but you will learn, and a lot of you probably already know, sometimes when people start talking about death, there can be some kind of irrational thoughts, right? You could hear a client say, hey, I know I'm in great health. I know the doctor says I'm super healthy, but every male in the family's had a heart attack at 63 and passed away. I'm going to have a heart attack at 63 and pass away, right? So I want to know, hey, if I didn't pass away, what's the living benefits I could have at age 63? We can show what that projection is at. So to do that, you would just come down here and change. Again, they need to be in chronological order, but you could just change that summary age to age 63, and it'll show up in the full illustration report. So again, you're not spending a ton of time on here, but you certainly can. And then on our interest rates tab, so if you wanted to do a different allocation mix, you'll see right now we default everyone into the strategy 1. That's the S&P 500, the point-to-point that has a cap focus. Again, you'll see that it's the highest of the assumed rates. It defaults to that, but you could certainly change that. You know, so if you wanted to do 50-50 in one of the other strategies, you could certainly do that. You just need to make sure your total allocation equals 100, right? So you could do that. If you wanted to be even more conservative than we are, you could drop that down. So we're at 603. You could say, hey, I want 6 flat. You could do that. Unfortunately, we're not going to let you do more than what we feel comfortable with. So again, we're a 175-year-old mutually owned company, right? Second oldest mutual company out there. We're pretty conservative. Again, we like the idea of under promising and over delivering. So although certainly there's other folks that might illustrate better than we are, we're about keeping good on our promises, right? So we're okay being not illustrated sometimes. But that's where you could go if you need to change your allocation mix. I'll show you in the illustration software how we get that 603, kind of the math behind it. It'll matter if you have an engineer as a client, you know, that type A personality. Generally, most clients aren't going to want to get that far into detail. But when I go to Quick View, it gives me that summary. So here's that $400 a month that we said we wanted to pay in premium. You'll notice, again, we did it a different way. We did it by naming the premium this time, but our plan premium and our guideline premium still match, right? 4,800. So we're putting in the most that we could possibly put in every year. That gives us kind of this random 589 of death benefit for that end. And again, on this level option A, it's growing. And then when we get down to our retirement age, it starts taking income out. So in this scenario, we're getting about almost $33,000 a year. Now the loan amount is slowly increasing each year because basically in let's see, at age 70, we're taking a $38,000 loan to give the client the $33,000 of spending money, and then that other $5,000 is basically covering interest on previous loans, right? So that's why the loan number is slowly going up. But you'll also see, even though we've loaned this money out, and you'll see your cash surrender value has dropped because we've loaned the money out. Notice that it's actually a loan from National Life Group, right? Because your money is still there in your account value, accumulation value here, and all of it, including the amount that's been loaned out, all of it's still getting that interest credited, right? That's how these things look really, really good and give you that tax-free income for life. Pretty powerful story here. So again, you could show the solve for income if you wanted to. I typically would just show one and then just have that conversation, that story with the client of, hey, there's multiple ways that we can take money out at retirement. We're going to do what's best for you. And the nice thing is we're not making you decide this now at age 30. That'd be crazy for a company to say, hey, you got to decide right now what you want to do 35 years from now. No, once we get here at age 65, that's when we'll say, okay, well, you know, for you, Mr. and Mrs. Client, what makes best sense for you now that we've reached retirement? So again, really, really cool story there. So I'm going to show the report real fast just to highlight a couple things, but then I'll show you guys an increasing amount. So here's the default illustration report that we'll run. There for the folks, again, I understand a lot of you guys want to know how this works, or you might have an engineer. I want you to have everything. If you've talked with Lindsay and I, you'll see, or anyone really at the company, NLG is very transparent. But we also don't want to drown people in quicksand, right? And so on the default, we don't necessarily have the full policy charges and expenses or the internal rate of return report there, but it's always at a fingertips grasp. So if you want to see what the charges look like to compare us to another company, or you want to look at what internal rates of return, hey, that's great. We'd love to help you with that. Just come here to check those boxes if you want to add that. They'll just show up at the very end of the report. No big deal. So let's hop on an actual run report here for a second. Specifically that I added those two reports. It's going to be a lot of pages, so we're not going to go through all of it. I don't want to freak anyone out. But again, there's kind of that puzzle piece. Again, it really tells our story really well. So not just death benefit, but it's also going to help your client if you become ill. Or if, again, marketing did great on color coding this, everybody wants to be in the green, right? We all want to be in the money. Of the three, most of your clients, if they could, they would pick the problem or the financial concern of living too long, right? The trick is we don't know which one life throws our way until it's on our doorstep. So cool things here. This is kind of just a summary page. So this specifically is giving you the summary of values at age 66. So just that one snapshot, there's what your death benefit is, or if you've started taking income out, you could do that, as well as here's the projected amounts of living benefits. But again, it's just that one snapshot. It's just at age 66. So it's nice if they're specifically looking at that age, but if they want to see everything, we might go a little bit deeper. Again, just another way to kind of lay out the puzzle piece, showing all three of those options. We're going to take care of all of those financial concerns that could come up. But the one page I wanted to show, because we changed it in the illustration report. Remember I said, hey, you might have a client that irrationally or whatever says, hey, you know, every man in the family's had a heart attack at 63. I want to know what those projected living benefits are at 63. Well, we can do that, right? So there's age 63 for the chronic, what that projected payout is. So it'd be $9,182 per month. If they do that on the monthly side, it'd be 50 months, right? 2% of the death benefit. So that would last for 50 months roughly. And then the terminal, critical illness, critical injury, those are all lump sums, right? So that chronic one is coming out again monthly until they run out of money, which would be 50 months. But if they did a terminal or critical, that would be a lump sum. So again, you could just look at the different amounts. Again, key takeaway: the more severe the injury is in terms of affecting life expectancy, obviously the higher the payout would be. So no surprise, terminal illness is the highest, but life-threatening obviously would pay out more than a Category 1 minor would. So again, it's hard that, you know, obviously we can't tell the client specifically the dollar amount. We don't know how the policy will perform, but it's nice to, again, get a good line projection of what we think it would be based on getting that 6%. So.
Hey, Jim, can you hear me?
I can, yeah.
Hey, Alliance family, it's Lindsay. We do have a question in the chat box, Jim. If we can just scroll back to where you were talking about the surrender value and the accumulated value. And the difference between those two. Sure.
I wanted to do it here on the actual ledger. We can kind of go over that. So again, lots of things happening here. We're really going to be focusing on kind of this right-hand box. So the alternative current rate is here. Alternative current, we're basically just showing the fixed amount. So if we got 3% every year, how would the policy perform? We're not planning on the market doing 3% like clockwork every year. Again, we're running at 6.03%, but it's taken a while for all the money to get into the indexing strategies because we're taking care of costs and whatnot first. But notice so during the first 10 years, there are surrender charges. So again, how that works is generally insurance companies aren't making money on policies till generally year 7, give or take, right? You know, we're paying overhead, we're mailing the policy to you guys to deliver, we're paying your commissions, right? There's a lot of costs that are coming out up front. And so what the surrender value basically does is if the client decides they want to leave and go somewhere else, it allows for the company to recoup the costs that we've invested in that client for that business. And so for the first 10 years, you'll notice the accumulation value and the cash surrender value are a little bit different, right? That accumulation value is higher. That's the accumulation value is how much money is actually in the policy performing for you and earning interest, right? Whereas the cash surrender value is if I surrender it, if I walk, I call up and say, Jim, I'm done. Give me the money. I'm walking. How much money would you receive, right? So again, in those first 10 years, you have more in there than we'll actually let you walk away with because we're wanting to make sure that we break even, right? Once we get past year 10, you'll notice they're the same for a while, right? And that will continue to be the same until we start taking money out, right? So let's get to the fun stuff. So once we start taking money out, here we go. Once we start taking money out, then you'll see there's a difference, right? So again, at the end of 65, still the same, but once we start taking our lifetime income out, right, that roughly 33 grand a year, you'll notice the cash surrender value is dropping, whereas the accumulated value is staying the same, right? What that cash surrender value means is it means I've already loaned you 33,000, right, of your 494. So if you call me up and says, hey, Jim, I'm walking, I'll give you the rest of it, but I'm not going to give you the same 33,000 that I've already given you, right? So that's why your cash surrender value is starting to decrease, whereas the account value is continuing to climb. That's what's important because that means all the money is still in that policy, still getting interest for you, right? Now, yes, if you call and walk, you know, you're only going to get what you haven't taken as a loan yet. We're not going to give you the 33,000 again, but every year when we credit interest, you're getting interest credit off of the full accumulated value. So again, that's a really cool. That's why these things look really good the longer that we let them go. So hopefully that's helpful. Certainly give me a call. I'll give Lindsay a call or Gina a call. Find it if you want to talk more on that. I skipped one slide. I'm just going to show it very briefly. I'm working right now with marketing. I'd love to get a visual of this slide as opposed to just data numbers. So if this goes over your head, don't think twice about it. But this is in essence the math or the science behind, Jim, why are you guys doing 603? And so what this is you'll see the dark gray columns here. That's actual market data. So hey, what did the S&P point to point do in 99, 2000, right? .com bubble, the early thousands. Hey, look, there's 2008. Everybody knows that one. So that's actual market performance. And then we compare that to with our cap and our participation rate, what would your client have gotten if they had been with us at that time period, right? So some years they're capping out. In those negative years, again, we're showing up with a zero. Again, this is the real zero is your hero piece. And then you can look back, okay, over the last 5, 10, 15, and 20 years. So that 10-year, we're actually at 6.71. But again, we want to be, again, 175 mutual owned company. We like to be conservative. We feel comfortable with showing that 6.03. So again, don't read too much into all the numbers. It's there for the folks that want to dive deep. I would again recommend, unless you're working with an engineer, you probably don't want to go this detail in your client meeting, right? Start smaller, and if that client keeps asking, then you can pull this page back out if need be. But again, I want you guys to know kind of that's there, how it's what's the math behind the science, right? So there it is on that. So again, really cool illustration there. I'm gonna go back to quick view because I like showing the kind of the overview version. But yeah, so that's how we would run that normal illustration. Again, once we like it, it looks nice and neat, we're gonna save it. So I'll click Save As up here. Get lots of blue dots here. This one runs the report. You could save it. You could copy it if you're trying to make a case that's a little bit different. I'm not going into InsMark today, but even if you were launching InsMark, that's where you would launch it. So once you save as that case, we'll do NAA sample. So once I save that case, now it says that NAA sample. Now NLG, National Life Group, our home office can pull that case, right? Cloud's picked it up. We now have all the data. So if you launch the eApp, it'll do it for you. It'll give us all that data. If you end up, let's say the sales desk runs an illustration for you, or you end up doing an illustration later, if you have saved this and there's a unique ID number, you want to reference that on the application. I'll show you where that unique ID number is. So before, when I didn't have it saved, these were just page numbers. But now at the end of each page, there's actually a 5-digit code. And so again, if you do eApp, this does it for you. Don't worry about it. But if you're doing a paper app or starting an eApp from scratch, if you can reference this number, then that will tell new business, hey, there's an actual illustration that Jim used for this case, and they can match that when they send the illustration out. Here's why that's important, you guys. So again, notice the illustration we ran here. We wanted to show supplemental retirement income, right? There it is. We're taking out $33,000 a year. If we didn't reference that number, right, you didn't do the eApp or you didn't reference this 5-digit number, new business doesn't know that you're showing income, right, at age 66. So what new business is going to send you is the batch illustration, right, which is showing us paying the $4,800 like we're doing in year one. It shows us doing that all years and never taking money out. So I don't think that's happened to too many of you guys. I know most of you guys do the eApp, but again, just a quick reminder: if you don't use eApp, make sure you use this 5-digit code. Otherwise, you're almost going to have to resell the client at delivery because the illustration isn't going to match what you showed initially. So just wanted to make that kind of quick little caveat. Save as, or better yet, just click the iGo eApp and launch it from there pretty quickly. And then again, here's that income coming out on the back end as well. Now I do want to show an increasing one here in a second. Let's see. So what's the total investment or in terms of premiums paid on the illustration? So one quick way to do that, the full report would tell you as well. But what you could also do is in this values as of section, it defaults to 1. But if, let's see, I stopped paying in 37 years. So if I just did values as, let's say 40 in this case, it'll tell you, hey, I paid 172, almost 173 in total premiums in this illustration. And the cool thing is you can do that while you're still on death benefit and funding. You don't even have to go to Quick View to see that. So you're at 172, which is pretty impressive because even though you've already taken out some income, you still have 430,000 that's in your cash surrender value. So again, these things are, the longer these things have to go, the better they're going to look. So again, really cool on that end. But even for your older clients, I know I've been working with a few of you guys on some older cases. A lot of times we'll still end up being able to use this because they're looking, to do a legacy play. They're looking to leave behind, that death benefit that's permanent. That can be an attractive one as well, So let's go. I want to show another thing here. So I've heard a few of you guys talk before about, hey Jim, we want to be able to build the increase, right? In fact, I'm just going to open up a new illustration real fast. I know a few of you guys will sometimes run one on an increasing death benefit, and then you'll actually show different premiums later on. So you might say, hey, minimum death benefit max cash, we'll do an increasing death benefit, and maybe we'll level it out at age 66 in this scenario. So if you do, yeah, again, on that illustration ID number, if you do the EAP, then the system does it for you. But if you don't do an EAP and you want to use that unique ID number, you can just put it on the agent report. That's a good question. So if we do increasing option B and we'll level out age 66, on our premium, we can then name that premium amount. So I've seen a few of you guys before will say, hey, we'll start off doing, let's say we'll do $150 a month, right? And if you did that for till age 65, let's call it. So if you did $150 a month to age 65, that's going to give you about 89,000 of death benefit initially. But if you build the increases here, so let's say we're going to pay one to year 5, they'll do 150, and then after that, they'll increase it up to 350, right? And we'll do that from 6 to let's do 6 to 10. Right, you can build an increase. Now notice each time I'm building a higher premium, notice my starting initial death benefit is going to be higher than that initial 90,000, right? Because we want to be able to put that $500 a month in those years 11 through 20. So we need more death benefit up front now, right? And that works, right? And as death benefit goes up, you'll notice target premium is also going up, right? So again, as the death benefit now up to 346, that target's also increasing, right? Which is good because I do want you guys to get paid. I want you to work for free. But remember, bear in mind when we go to Quick View, because we have more death benefit now for those bigger premiums later, you'll notice the surrender value in those early years, that cash isn't quite as nice as it otherwise would be, right? Even though we're trying to maximize cash, we can't do it in the beginning years because we need to buy this amount of death benefit so that later on when we really want to pay premiums, right, we can without it necking. So what that means is if we end up not doing those increased premiums, then this policy could be in trouble, right? It could run into lapsing. And so typically that's why I kind of like doing this level. I like doing this level option A to start off is, so let's see, 400. Let's make these clients about the same as we can anyways. So we'll do a female as well and make her age 30. Just want you guys to see this point for a second. So again, at some point we get to, right, at some point we get to doing $500 a month, right? And then $700 or $750 a month, right? And again, we've got increasing death benefit starting at $368, and my target's $2532, right? But what would you say if I said, hey, I can give you even better commission than that, better comp than that. I can give your client more death benefit in the earlier years, but also let them increase premium later. And even if they don't increase premium later, this policy is not going to fall apart, right? Because right now this one, if you don't up it to 9,000 in those later years, this eventually could be in trouble, right? Well, simple. If we do the same min max, same for 30-year-old female, we do min max on level option A initially, right? There's more death benefit for the client, year one. There's a higher commission for you. Thank you very much. You're welcome. And your client could still pay more premium in later years if they want to. Now, you don't necessarily want to show that in the illustration, but what you would do is, again, we're min maximum on $400 a month. That gives us this death benefit. Let's say your client calls you and says, hey, Alex, you've been great, but I now want to increase my premium even more. Well, what you'll do is you'll pick up the phone, we'll call National Life Group and say, hey, we now want to change this to an increasing death benefit. And let's say we're in year 4. Anytime after year 1, you have to stay put in year 1. So let's say in year 4, your client says, hey, they're ready to do more premium. We could run that. And in fact, if you want to show, just so you guys see it, I would not go this far in a meeting, so don't do this in a meeting, but just so you guys see. So there's that level death benefit, that $589 initially, right? And you said, Jim, just how much more could we pay? Let's find out. So we're in the 5th year, we're going to pick up the phone and call NLG and say, hey, we want to change it to an increasing death benefit. And let's see just how much more we could pay. So you'll say, hey, Jim, once we change it to increasing in year 5, how much can we pay in year 5 all the way to retirement, right? Again, you wouldn't have to go this far, but you certainly could. Bam. You could get, although you're doing $400 a month now, you could eventually jump to a little bit shy of $1,000 a month, right? But more than double your premium. Client could do that, right? But the key thing that we showed before, yeah, you still got income down the road. Actually, it could be higher because you'll probably level this thing out again when you get to retirement. But the point being is more death benefit day 1, right? More comp for you guys day 1, and you still have that ability to increase premium if need be. But the key thing is if you end up never increasing that premium, you just keep it at that $400 a month all the way through, to age 65, then this policy still works. In fact, it works pretty well, right? $589, you never increased premium, and you still got $33,000 tax-free to show for it in retirement. So I typically would recommend, running them that way if you want to show the ability to increase later on. One caveat or one time you can't do that is sometimes if you're working with children, a lot of times those young kids, you end up doing increasing B just because their cost of insurance is so small. So let's see. I want to see if I thought we had another question that I skipped over. Okay, we'll definitely keep questions coming in. Let me show you guys. Well, I say, hey, sometimes with kids you do increasing B. Let me show you what that looks like. So let's say you're working with maybe it's one of your own clients, or one of your own children for that matter. So let's say you've got a female that's 2 years old, right? I'm not going to worry about EAP on this one. We're just going to go through. So you had a female that's 2 years old, and let's delete these. So we want to do min-max for that child, right? But notice if we do 150 bucks a month, because they're so young and their cost of insurance is so small, that's a lot of death benefit, right? 650 for a child. So that's a lot of times why if you're working with a kid, you might run it on increasing option B initially. And again, you'll probably level it out once they're ready to retire, right? So we'll do that to age 66. And then, yeah, one question came in is, hey, can we lower face amount later on if they don't add more premium? Yes, potentially. And in fact, when we showed the lifetime income benefit, that's what we did. We reduce the face a little bit. It'll be hard to do it a whole lot because again, you're already starting off with the minimum possible, right? When you do minimum death benefit max cash, that's what you're saying. You're saying I want as small death benefit as possible. So you could do it some, but not necessarily a whole lot. So let's show that this child policy. So you're doing 150 bucks a month, and let's say we're going to do that. Let's actually show let's show them utilizing this for both a down payment on their home, right? Let's say mom and dad's going to help out with college, but the child's going to use this for a down payment on a home when they're 30, right? So they're going to pay the 150 a month to age 30. And then what we would do is we would say, hey, how much could we take out in this 1 year? So age 31 to age 31, what's the most we could do? And again, the policy still reach maturity because we don't want this to lapse. So if we did that, in this one, it's showing about 114. I'm going to round down because again, we don't want this to lapse. So what we could do is we could say, hey, let's specify that 110 from age 31 to 31, right? Show that house payment. That's a nice down. The same 150, and we'll resume it to retirement, right? To age 65, right? And then now when we're actually retired at 65, now we'll do actual. So we won't be able to do lifetime income benefit because we have an outstanding loan here, right? And again, to use the LIBOR, we have to be paid up on our loans. But we could do solve for income. Right. So again, we're paying that 150. Sorry, paying one. I apologize. But again, we're doing 150 a month for all years, and then we're showing one lump sum there for a house as well as doing an income at retirement. So let's take a look at what that would show. So there's my almost 300,000 for our young little one now, paying along as we go. There's a big boost for a house down the road. Now again, notice I'm not taking actual income in those middle years here, but I'm not taking any actual income to spend, but I am doing a small loan because the interest increasing up. And then again, in this one, a good chunk here. Obviously, if you did.
Hey, Jim, your phone just clicked out for a little there. I don't know if you want to just repeat that one point.
Sure. Yep. Yeah. Am I coming back in now?
Yes, you're loud and clear.
Okay, perfect. So again, in this scenario, I showed us taking out some money here for like a down payment or whatnot. That's pretty aggressive, right? If you take less than this, then you'll have obviously more down here at retirement. But what's happening here in these middle years is that even though I'm not taking actual income, we are taking a loan in these years to just cover the interest on our outstanding loan, right? So that's why obviously it's a lot smaller because I'm not spending 110,000, in these middle years here, but I am paying the interest on that loan. And then again, once we get to retirement, there's some more tax-free income. Obviously, if you did only 50,000 or 30,000 up here, you'd have a lot more later on at retirement. but you could certainly show that as well on that increasing piece. So again, some cool questions there. Let's see here. I do know that it is, we can run illustrations on iPad. Lindsay, do you remember what browser we like? One, yeah, you'll have to make sure your pop-up blockers are turned off on those iPads. Is it Chrome that we like, or is it Chrome that we don't like, Lindsay? Do you remember off the top of your head? I know we like some and not others. So we'll look to see if we can get you an actual answer on that in terms of which browsers we like on iPads and which ones we don't.
Yeah, I would definitely say try Chrome. If that doesn't work, try Internet Explorer. But honestly, most of the time it's a pop-up blocker issue.
Yeah. So you'll have to make sure up here that you allow pop-ups to allow that illustration to really open up. That's a good question there. Lindsay got the lapse notice earlier. Let's see, what was another question? Oh yeah, good question that came in when I was showing how I typically run them on a level death benefit and then change it later on. So that's the other thing that I like about doing them on level A initially, is that yes, to Alfonso's point, when you call home office and say, hey, I'm now ready to change this 589 from a level death benefit to an increasing death benefit, that does not go through underwriting again. That's not a material change, right? You're just changing level option A to now increasing option B. Now, if you called and said, hey, we want to change it from 589 to 750 or 800, right? That would be a material change. You'd go through underwriting for that added amount. But yeah, just switching it from level A to increasing B, or on the back end at retirement, changing it from increasing B back to level A when you retire. No, those don't have to go through insurability. Good question on there. Let's see.
Jim, do we want to open it up to the group too? If anyone has any major, client concerns that have come up when you've shown an IUL illustration, or major objections, obviously we can't take 100 of them. There's over 200 people on the call, but just wondering if anyone could put any of those in the chat box, and maybe Jim and I can kind of go over, how you would overcome those objections, because obviously we want to help you as much as we can. So if anyone's had any of those, feel free to put those in the chat box. That might be a good use of our last 7 minutes with you guys.
Yeah. I'll lead with one while we're monitoring that chat box. So a lot of times, one of the questions will be, hey Jim, this all looks great. In fact, it's it looks a little too good to be true, right? How do I get a policy to where, I've ended up putting in 173,000, and we get 589 if I pass away early, or I get 33,000, guaranteed when I'm in retirement. And again, that's where I would this is not a good solution for us. Sorry, I'll say that again. Internet connection was jumping in and out again. So again, if we only do this thing for 2 years, then this isn't a good deal, right? We put in about almost 10 grand, right? Have about 7,000 of accumulated value, but if we actually walk, we don't get any of that back. So again, definitely not good in the short run, but yes, in the longer run, this could work out. And I would be so bold, guys, that at least some of your overall insurance should be in permanent, right? And because as a term is great, but the downside with and you guys even have some good term products that you sell, but the downside is I'm not planning on passing away in 20 years, right? Which means I'm hoping for the scenario where I'm ultimately just flushing my term premiums down. It's like all, but no, you're not going to get those premiums back, right? Whereas in this, you know, ultimately, if you wanted your premiums back, yeah, you could call us up at 65 and say, cash in 173, you've got about let's see, if you do it right before you retire, you've got 470,000 in cash, right? Now you'll get taxed on that delta, right? But you put in 173, so the rest up to 470 that would get taxed, but that's still not a bad deal, right? These things, when you fund these correctly, these things pay for themselves and then some at some point. Again, obviously, if the market doesn't perform well, it might take longer, but in the long run, it certainly gives you more flexibility, you know, for folks that still work with companies that have some sort of pension. You know, having something like this lets you take advantage of that pension by focusing more of it on the one person, as opposed most people with pensions, teachers, even Fortune 500s that still have pensions, most people end up taking the survivor benefit, right? So, hey, I'll take a smaller amount of that pension, but pay it out as long as me or my spouse is alive, right? Well, if you help that client set up an IUL when they're 30 and they have permanent death benefits still at retirement, then there's no need to take a reduced payout on the pension to make sure it pays as long as either of you are alive, right? Give you the full amount. If something happens to you, you'll refill that pension bucket with a death benefit of almost 600,000. So, all right, let's see some other questions here. Yeah, we will send out our contact info. Well, yeah, I'll blast that out here in a second. That's a good question. That by that which won't require underwriting to step in. So again, it's hard to know unless you run the actual illustration and show that change to increasing B in that year. Like I did, I think in this one it jumped from 4,800 to I think 11,000 per year was the most we could do starting in year 5. So yeah, if the client wanted to do more than 11,000 a year in this scenario, you'd probably do add an additional IUL, which you could do, but that would go through underwriting for that second IUL. So yeah, so one question was, could we revisit the increasing B illustration with the tiered premiums? Yeah, we certainly can. Again, hopefully you saw as I kind of showed the advantage of both, right? This age 30 female running them both ways. You're going to be better off doing it in this scenario, doing it on level option A. But yeah, what you would do if you wanted to show that would be you'd go to that death benefit and funding. You would go back to your minimum death benefit max cash. You would change it to increasing B. And then again, make sure you level out the year after you stop paying premiums, right? You don't want increasing costs in retirement when they're not paying any more premium. And then for the premium, you would just add a row, right? So you could do $200 initially for 5 years, let's say. Now notice if we do that, then right now it's 126 of death benefit. But notice when I add that second row of premium to say 450 a month in years 6 through 11, that death benefit's going to jump up, right? So now it's up to 288 rather than 125. So again, that you could certainly do it that way. And again, yeah, each time you're increasing it, the death benefit and target premium goes up. But again, be careful. Years, this policy could run into trouble later on down the road. Then at that point, pay some more premium. So, in terms of max death benefit that a child can get, yeah, Lindsay actually just answered that out to everybody. Perfect. Thanks, Lindsay.
I got you covered. Perfect.